Hello everyone. Let's start 2026 with one of the clearest signals markets are giving us right now, the US yield curve. If you look at US treasuries, the curve has steepened sharply. The spread between the 2-year and 30-year yield is now close to 140 basis points, and even the 2 to 10-year spread, it is back near the 70 basis points. That's the steepest we have seen since late 2021. And it marks a clear shift from the long inversion phase that we saw between 2022 and 2024. So what's really happening here? Simply put, the short-term yields, they are coming down because markets, they expect Fed to cut rates over time. At the same time, long-term yields, they are staying elevated. Why? Because investors, they are demanding higher compensation for long-term risks. Things like fiscal pressures, heavy government borrowing, and lingering inflation uncertainty. Now this is very different from the past few years. Earlier the curve was inverted because the Fed was aggressively hiking and markets, they feared recession. Now the curve is steepening because policy, it is expected to ease, but the long-term risks, they haven't gone away. Now, what does this mean across the other asset classes? For equities, higher long-term yields can limit valuation expansion, especially for the growth stocks. However, sectors like strong cash flows and pricing power, they are likely to hold up better. In bonds, the message is clear. Even if Fed cut rates, long duration bonds may not deliver strong gains because elevated term premium is keeping the long yields under pressure. Interestingly, for gold and silver, the usual link with the real yields has weakened. Geopolitics and reserve diversification are now the major drivers. So a steep yield curve may not hurt precious metals the way it did in earlier cycles. Now let's talk about dollar. A steepening curve driven by falling short-term yields is typically negative for the dollar, and we are already seeing that. The dollar index, it fell by 9.4% in 2025, its biggest drop in last 8 years. Now, with markets currently pricing in 2 more Fed rate cuts in 2026, the dollar is expected to remain under pressure in the short term. The bottom line. The steepest yield curve since 2021 is not just a technical move. It tells us that 2026 could be a year of selective equity performance, limited bond upside, resilient safe haven demand, and continued pressure on the dollar. Any dollar rallies in this environment, they are likely to be corrective, not trend changing. So the yield curve will be one of the most important macro signals to track through 2026. Thank you and stay tuned for more updates.